This is The Market Capitalist, and I am Dominica Johnston. Thank you for tuning in. Efficient markets and old news. Efficient market theory suggests that all the news that is old is already priced in the stock. Therefore, your analysis should not focus on what has happened, but what will happen, the unexpected that's going to arise, in your opinion, in the future that's going to impact a stock negatively or positively. I believe in efficient markets to a point. There's certainly people that, because efficient markets kind of suppose that all investors are thinking a certain way. And therefore, because I, the investor, if I don't believe in efficient markets and I am going out and I'm saying, oh man, last month this happened, I'm going to buy this stock. And I have enough money, I'm going to be able to move that stock price up based on old information. But typically, your well-followed stocks that have a couple analysts following them are going to move based on when information becomes available. And therefore, once that is publicly known, the person is going to act on it that's putting the order. But what you often see is on these smaller stocks, often penny stocks, some smaller stocks either not on major exchanges or not on exchanges at all, that get priced, news comes out, maybe some momentum happens, but there's a delay. Essentially, you're seeing good news happen, and then the stock takes off, but it takes off for an extended period of time. And I think really two things are happening there. One, you're having the news being priced in by investors saying, oh, great piece of news came out. Let's push the stock up because this is going to improve future growth prospects, whatever. It makes it a more valuable company. So that does get priced in. But then I think two things are happening. One, it elevates the stock's exposure because you do have this price momentum that has built up, in the last couple days, and people start to take notice. Therefore, the news that is old is actually new to them, and they're acting on that news as if it's a new news, even though it may be a week, it may be a few days old. So when you are dealing with stocks that lack exposure, essentially the good news, or even bad news, is increasing their profile, therefore increasing their exposure, which is bringing a lot of new investors to the game, even though it may be a couple days, couple weeks after some type of news story breaks. It's very interesting, actually, because it really gives you, the investor, if you're watching these, thinly traded stocks, penny stocks, stocks that aren't on major exchanges, if you're looking at them and you know that in a month and 2 months, whatever the time frame is, that some type of significant news is going to break on a stock, you almost have a small window of opportunity to really cash in, where you're kind of shielding yourself against all that risk because you know that X event is going to happen. Well, if X event turns out to be bad, the stock's going to take a major slide backwards because the people that are holding it are going to say, things aren't as good as I thought. I'm going to get out of this position. Same thing happens. Oh, the news is good. Well, of course, current stockholders and other people that follow the stock are going to probably buy in, pushing up the price. You may buy in as well, push up the price. Because of that increase in price, assuming that it's somewhat significant, it's going to draw the eyes of other investors that haven't been watching the stock. And therefore, they're going to look at that piece of news and evaluate it on its terms, even though it may be a day or two old, and then act on it, therefore pushing up the price again. This might happen over and over again. You see this a lot with smaller companies that have significant news come out, and then they take off. And sometimes it's sustainable, where they do take off and then they kind of level out or have a small pullback and then they continue appreciating in value. Or sometimes it's a steep run-up followed by a very steep decline. And that's because what's happening is more and more investors are coming in and saying, oh, great news. Well, really they're late to the game, but because the stock is so thinly followed, they could have so much sway where, we're talking in a previous video segment, we're talking about investor sentiment where, really you want to focus on investors that have money, not non-investors that don't have any money in terms of whose opinion matters. Well, as a stock becomes more exposed to more investors, you have more people with greater amounts of money willing to put their money forth into a stock because of this news article or whatever happened in the past. So as far as the markets being efficient in the way that they're processing information, yes, it is actually efficient in a sense where the people that are in the know at the time are acting on whatever the information is. There's really not a lag there. It's, press release comes out, read the press release, you act. But because a stock is so thinly traded, the press release is really like a big advertisement via the reaction it draws to other investors to say, hey, I didn't even know this stock exists. I didn't even know this company was in existence. Look what they're doing. I want to be a part of this. And therefore, it pushes the price up even more and draws some more investors in. And this continues on for, however long. It could be days, it could be weeks. But eventually, it bears out, or it fleshes out that, yes, that news was so good that it warranted that certain high valuation, or, wow, you guys really over-speculated on this one and it's going to pull back deeply. So I think it's a very interesting strategy to go in and kind of get an edge on the market by looking at it could be a certain sector or particularly certain small companies that you're able to do a decent amount of research on and understand enough to say, this event coming up in March is going to significantly, be a fork in the road, whether the company is going to thrive or the company is going not to thrive in the future. And therefore, you can shield yourself from the danger of having to jump in early before you know about something, but still be able to gain the upside of a stock if that news is actually good. So I hope this helps you in terms of thinking strategically when purchasing or planning to purchase a stock, and helps you kind of understand the efficient markets theory and how, yes, it does work, but there's always those exceptions where you have areas that are really unknown to people, or specifically companies that are unknown or not well understood by people. So thank you for tuning in. Comments, again, always welcome below. I appreciate them, and we'll see you on the next episode. Thanks.